Welcome to the Daily Update. This is Being Prepared Friday, September 2nd, where we'll go over the action in the market today and then see how things look for Tuesday, September 6th. And please be reminded that the markets will be closed on Monday in observance of Labor Day. So I hope all of you that get to enjoy a 3-day weekend have a nice, relaxing weekend, maybe barbecue that one last time. It's kind of the unofficial end of summer as we get set to go into fall and the beginning of the school year. And we've got an election coming up and all kinds of interesting things that are happening. But at least for this weekend, I hope you get a chance to relax and have a little bit of enjoyment. So let's go back and talk about what happened on Friday. Right at the open, we did have a gap higher. The market seemed to like the employment situation report that came out. I'll go over it in a little bit more depth here in a moment, but some parts were a little weaker than expected. Some were more stronger than expected, but we were also fighting against a short-term oversold condition. So we might have seen some kind of a bounce from that. So we did end up going up to R1 at 39.90. And then we even advanced up to R2. We were able to get back above 4,000. And we went up to R2 at 4,013. That was pretty much the good part of the day. As the day went on, selling then took prices back below R1 and down to the unchanged level. And then they actually went negative and fell all the way to S1 at 39.24. So it started off really positive, but then turned pretty negative as we went on. Going into the close, we closed at S1. We ended up being down 1.07%. Volume went back to below average. And if you watched any of the brief videos that I did over the past few days, the last day of September saw above average volume, and the last day of August saw above average volume, and the first day of September saw above average volume. Well, in Friday's session, we're back to below average volume. The technicals are still pretty negative overall. There are some positive things that we can look at, and I'll go through that. But all of our indicators, our oscillators, we're breaking below moving averages. It's just not a pretty technical picture right now. Inflation and interest rates, as well as growth concerns, that's what the market is fixated on most of all. And I even read something that I'll allude to here in the notes on the next slide, where because of the employment situation report, immediately there's this scenario floating around out there that perhaps inflation has topped out and is starting to come down. And that's the reason they give for having the positive open that we saw on Friday. Don't really pay a lot of attention to that. We have technical bounces. Some of the biggest moves up you'll see when we're just screaming to the downside. And of course, the opposite is true. Some of the biggest down days will be when we're in a bull market. That's pretty much what they're going to use for any excuse. If we go up from here because everybody thinks we're going to go down, it must be because inflation is topping out. Even though we do have some data behind that, we have not heard anything from the Fed to really amplify that in any way, shape, or form right now. So just take what you see on the charts. If we're going up, we're going up. If we're going down, we're going down. And yes, there are these events and situations that are going on that can have an influence, but we look at the charts overall. We also have a whole list of geopolitical concerns, but those are still kind of on the back burner with things. Earnings are being released on a company by company basis. There's still kind of this debate going back and forth. Are we in a recession? Are we not? What is a recession? What isn't a recession? And then any Fed speak that may come out specifically from Chairperson Powell. That's the person to really pay attention to. So some market comments. This is what I was talking about, that early in the day, there was a belief that the strong August employment data, when you compare it to July, might allow for the Fed to be more dovish. Well, see, that's the only scenario they can come up with right now. But then we got some other news. Gazprom, which controls the Nord Stream 1 pipeline that goes from Russia over to Europe and into Germany, they have decided to shut that down. and they haven't really given a date on when that might reopen. Now, Europe's already been really battling here, and it could be a very, very difficult winter for Europe as we get colder. And then to throw that news into this as well, that kind of turned the tide a little bit and turned things more negative. They said it was some kind of an oil leak, but there's not a lot of information, at least that I was looking at. Then about that same time, the G7 members, they agreed to impose a price cap on their exports of Russian oil. So you take the good that seemed to happen in the morning where, hey, maybe inflation's dead. And then it quickly changed to, uh-oh, the world's coming to an end and we have to really worry about things. I don't necessarily see it like this. I see that we went up and we hit resistance. There was no buying that was going to push us through that resistance. So we started selling, and they're trying to take different things in the news and just attach it to justify. Again, because the financial media wants to keep the markets black and white, that it's direct cause and effect. Well, there is cause and effect, but it's what we're seeing in the charts. And then sometimes things will happen that they try to attach to that, and that may not even be that big of a deal. But that's my stance. You may not agree with that. And there are things that do happen that catch the market off guard. Like last Friday, when Fed Chair Powell gave that pretty strong speech, that was more than the markets were expecting. And that's why we saw such a big down day a week ago. But for the most part, technically things are going to happen, and then they look for some kind of things to attach to that to give justification. All right. Another question that we have to keep asking as long as we're in this downtrend is, will prices drop down to the June lows? We don't know if that will happen or not, but we need to keep that in the back of our mind. Also, the trend line that I talked about in the daily brief video for Friday's session, that is still holding up as prices are short-term oversold. So that could give us some support. And I'll show you the chart of that one. Our sector rotation and our positive setups, they continue to be on hold. These are positive. So that means they get more powerful as the market goes up. When the market's going down, we kind of have to put those on the back burner. But we're also starting to see some charts that might get ready to generate new signals in the not so distant future. And again, I'll point those out to you. The 10 to the 5 and the 10 to the 2, they still remain inverted. We did have the 30-year to the 5-year that was inverted. That switched back to a more normal relationship. Interest rates, as well as the dollar and oil. Now, they're not as strong as they were before, having an inverse correlation, but they're still fairly strong in their inverse correlation. So if interest rates, the dollar, oil, if they're going up, stocks are generally going down, and vice versa. But we're seeing some more correlated movement in the same direction. So that those relationships are not as apparent as they were just a few days ago. Sentiment, it's turning more fearful with the down day, but we're not extreme. We're just barely off of neutral right now. So that suggests that on a sentiment basis, we might have more room to go to see some kind of capitulation and completely oversold condition that really could produce some kind of a bounce. But there are some positive things that we can look at to see, will we get the bounce before something like that happens? The economic reports that came out, we have the employment situation report, and that'll be the next slide. We also had factory orders, which declined 1% on a month-over-month basis. They expected it to be up 0.2%. So that came in much weaker than expected. Our trend is negative, and it's starting to get stronger. The ADX is starting to turn up, and I'll show you that. Because we had the down day, and the bias usually is just one day at a time, we're back to negative with the down day. And then I look at momentum as the last 2, 3, 4, 5 days, kind of the general picture of what's been happening. And that is still negative as well. We had the nice up day on Thursday, but that wasn't really enough to change our momentum. All right, here's the employment situation report. We had non-farm payrolls that came out and increased by 315,000. That's greater than what they expected. They expected it to be 300,000. So that's producing strength in the economy. We also had private payrolls go up by 308,000, and they expected it to be 280,000. That's also stronger than expected. The average hourly earnings, they rose 0.3% on a month over month basis. That was a little less than expected. They thought it was going to be up 0.4%. The unemployment rate actually rose to 3.7%. And again, the markets don't really pay attention to this. There's so much manipulation. There's so many ways that they fiddle with the numbers here that it's a headline number. Politicians like to use it. It's good for the media to say this is what unemployment is right now. But from a real important standpoint to tell us what's going on, and not so much. But that caught the markets a bit off guard as well, because they expected unemployment to stay at 3.5%, and it jumped up to 3.7%. And then the labor force participation rate, that jumped. That's how many people are actually in the job market right now. It jumped to 62.4% from 62.1% in the previous report. So that went up. That means there's a few more people in the labor force right now. All right, let's go back and talk about the session. Here is our fear and greed index. We had been neutral pretty much all week. We're tipping over into the fear side, but it's the high side of fear right now. Where we really start to get excited about this, or at least to make decisions on a contrary basis, is when we get down, especially below 25. That just shows that people are really fearful, and we're looking for some kind of a bounce because capitulation just might be happening. And here's the historical chart of that index, and it shows how we have been coming down, but we're still more in the neutral area. Here is the latest reading from the RIDEX bear bull ratio, where we're not showing a spike up. That would mean that people are getting into the bearish mutual funds, and they're not necessarily extremely bullish right now. That's when we get a real low reading. We're still kind of in the middle. It spiked up, but then came back down. And probably the next reading we'll get, because Friday was a down day, that'll probably go back up a little bit. But we're kind of bouncing around in neutral territory. Also, we had the weekly American Association of Individual Investors. They are getting back to the point where they're extreme negative again. And a lot of times we can use this as a contrary indicator. When all of these folks are feeling extremely bearish, a lot of times that can mark the bottom in the market. And that's why I have the chart of the S&P above. You can kind of see when we hit extreme sentiment, a lot of times the market went up after that. But we've been bouncing around in here for quite a while. We came up out of it. Well, now we're going back down into the extreme negative camp. And that's what a lot of our positive setups are doing right now too. Some Isabel Net charts. This just says, thus far, prices simply decelerating from bubble levels. So we have the UK and Canada, that's the light blue line. We have Australia and New Zealand, and then Sweden, and then the US prices for houses. And it just shows that we are seeing a decrease in housing prices. Now, we had another economic report this week from the S&P Case-Shiller index, and it's showing that it went up 20%. So again, this is more of year over year, where we're looking at more of a month over month in the report that came out. But overall, it is showing that housing prices are starting to come down. Another thing is CEO confidence. This is a survey, and then they compare it to jobless claims. When this goes up, that means CEOs are really confident. When it comes down, that means they're real pessimistic. And then you can compare, well, when they're not very confident, that's when they generally have to let people go. And so they're filing for unemployment. Well, this has been coming down as far as confidence, but we're not seeing a real rise in the initial claims for unemployment. This measures the risk appetite. When it's below the zero line, that means people don't want to take a lot of risk. When it's above that line, they're willing to get into riskier investments that give you a better return. And right now we're camped below the zero line. They're not really into getting into high risk investments, at least yet. This shows us the ISM manufacturing index and the S&P 500. The S&P 500 is in purple, and it's been going down. as of the time this chart came out. And the ISM has also been declining as well, and they tend to correlate quite strong with each other. This shows that it's an estimate put up by Goldman Sachs where they think the boost in commodity price increases on a year-over-year basis and the core PCE inflation will decline. Okay, well, I don't really know. They're kind of in that camp where maybe we've topped out with inflation and we might start coming down after that. At least that's what they're focusing on right here. We also have a thing called the Baltic Dry Index, and I have a chart right after this that I'll show you. It just shows what does it cost to send goods from one place to another place, generally using shipping. And when it costs more, well, that means that they have to raise their prices to cover those costs. When it doesn't cost as much, they can lower those prices, and it's really been declining lately. And here's the chart that I show here, where it also shows that we've been declining. It really spiked up, but has since been coming down. Every week, we also get the active asset manager survey. And with the negative week that we had previously, it just shows that they're getting into less risky assets. And we've actually dropped under 40, with the latest reading being at 32.36. When we get down into the 20s, these folks are human beings too, even though they're professional money managers. They tend to overreact as well. And we can often use this as a contrary indicator when we get extreme negative readings. Another thing is we think, and this came out before the report in Friday's session, that the market may come under pressure because we think, according to this chart, that in 2022 and into 2023, the unemployment rate is going to climb. Another thing to be aware of is a thing called seasonality. And I don't put a lot of weight in this, but we are coming into a time of year which historically has not been very good for the markets. And we go back to 1950, the past 20 years, the past 10 years, midterm years, which is what we're in right now. And in September, we have been negative pretty much across the board. Now, a lot of people think it's October because that's when we've had most of our crashes. But before October is September, and a lot of times that can give us some real weakness. We just have to follow the charts. If they're going up, we follow that. If they're going down, we follow that. That's my stance on things. Also, in an earlier video, I talked about the rule of 20, which is when you take the PE ratio and you add that to the CPI, and when it's above 20, that means that the market is expensive. And this red line is the rule of 20. And generally, when the red line is above this with CAPE, that's another way of calculating, it's the Robert Shiller way of calculating the PE ratio, that means that we're overvalued. When we drop below this, that means the market is undervalued. And we've been overvalued for a long time now, and we continue to be overvalued when you take this into account. So this is something that can go on for a very long time. So it doesn't necessarily mean that you have to adjust things right now. This is something to be aware of, that on a historical basis, no matter what they're doing to the forward earnings per share, because that's what the market uses, this is taking into account the historical earnings per share, the actual reports that were filed. We still continue to be overvalued. And at some point, the market will need to deal with that. Are we dealing with that now? That's kind of the question going back and forth. Another thing is, here's forward-looking earnings. They look extended. You see this dotted line, this is more of the average. And we've become really far away from that, and it's starting to come back down. That means that they're starting to revise the earnings per share forward-looking reports. They're starting to make them lower. And again, it's ultimately earnings that drive share prices. And so if earnings are going up, stocks go up. And if earnings are going down, stocks go down. And we're starting to see this begin to roll over. Another chart. There's the debate going back and forth, which I don't think people need to really waste their time on. There's a thing called a secular bull or bear market. And that's a market that goes in the same direction for years and years, even decades. And then other people say, well, we're in a bear market right now. And they might call that a cyclical bear market, where that might last for a few months to maybe even a few years. And the debate goes back and forth. Are we in a secular bull market? And what we've seen in 2022, is that a cyclical bear market within a bigger term bull market, a bear market within a bull market? Who cares? We follow the price action overall. This suggests that we are still, when you look at a really long range going back to before 2000, see the blue line and the red line, they're still going up. Now we've seen some weakness. So this suggests to us that we are still in a secular bull market. And what we've seen in 2022 is just a pullback or a cyclical bear market within a bigger term bull market. And again, I don't necessarily want to debate this back and forth because we follow the charts. So also, this chart is just showing that buybacks really spiked up in the most recent reading of this chart. These are when corporate clients are buying back their own stock. So if they think their company's doing well, if they think the stock price is a good price and they're buying it back, that could be positive for the market. Because when they buy back their own stock, that makes less of it available out there. There's fewer shares, and that adds some more intrinsic value to those shares as well to make them more precious. And that can also really boost stock prices. But we're not really seeing any follow through with price nonetheless. The big thing from this chart is just read the headline. History suggests revisions from the end of August to December. So for the rest of 2022 are negative most of the time. That's really the only important thing to get from this. But that means they're positive sometimes too. So again, these broad brush studies that we look at, it's interesting to know. It's kind of fascinating. I don't mind talking about it, but I don't use something like this to make my decisions personally. This is the Fed funds target rate, and this changes every day, where Goldman Sachs is forecasting in 2024, it will be at 3.4%. The futures market is actually thinking it will be under 3% or right at around 3%, but this changes all the time. Another thing is with that news that I was talking about with the pipeline in Russia, it says Russian gas flows are set to remain low. This is before the news came out, as a new 3-day pipeline maintenance is planned to start on August 31st. Okay. They were going to shut things down just to fix the pipeline, but then they found some leaks. And so they're keeping it shut down. And that's what's kind of freaking out the markets right now. So, and there's a lot of politics going on behind this whole mess. And this just shows how things have really decreased in 2022. And you can attribute a lot of that to the Russia-Ukraine situation. This is the US core PCE price, which came out recently, and this is on a year-over-year basis. This is where some of the folks are getting the idea that maybe inflation has topped out and now we're starting to come back down, but the Fed isn't ready to go to that level yet or pivot to focus on this, at least yet. Now, looking at Friday's session, we had growth down a lot more than value was with the large caps, also with the mid caps and the small caps. So growth really led the way lower. Here's the VIX, which this is a little surprising. We were down over 1% and the VIX actually fell, which is not generally what you see. When the markets go down, the VIX has a tendency to rise. Well, we're seeing the VIX going down as the market went down. This is the VIX of the VIX, which just measures how fast the VIX itself is moving, or the volatility of the VIX. It's been going pretty much sideways overall, even though it did inch up just a little bit on a closing basis. The Ulcer Index, and this is the daily chart. I'm not really focusing on the weekly chart and the daily videos right now. It just shows that as we've been coming down in price, fear has been increasing. And this is more in line with really what we're seeing. We're down 18.56% from the all-time high. The equity put call ratio actually declined a little bit. We had a down day. You would think the put call, you see the put is the first part of that calculation, but it actually declined on Friday. So the daily chart came down a little bit, and here we have the 5-day. And this is one of the charts that may be getting ready to generate another signal. The signal that we've been working off of was set back in June when we hit the low. Well, look at how this is continuing to go up. So it may come down and do another spike. And I have another chart to show you later on in the video where I'll talk about that again. Here are the pivot levels for Tuesday's session. And this is the one chart that I showed in the daily brief for Friday's video, where it looks like we might be holding up with this trend line. We came right down to this level. And I mentioned in the daily brief video that I drew this line on here a couple of days before this even happened. And it was kind of interesting how we came right down to this level. It looked like we were going to bounce up off of that. And when we came down in Friday's session, we're still right on this trend line for right now. We're still below the 50-period moving average. There's still a lot of technical damage that's being done, but we kind of want to watch this trend line to see, are we going to bounce up off of that, or are we going to fall through that and still see a continuation of declining prices? Here are the monthly, and these recalculate now because we're into September. These are all of the pivot levels, and they are good for the entire month right now. Then here's some short-term fib levels, which this goes back to the high that we set back in March to the June low, and we retraced more than 61.8%, and we've been falling below that. Well, this is some of the resistance that we ran into in Friday's session. We went up that high and then just stopped and then started coming down. Also, going back to the low set in June to the nice little run up that we saw, we're coming down, and this could be acting as support at the 38.2% retracement. We haven't broken below that yet, so that might be providing some support for the S&P. Here's another one that's a little longer term. This goes back to the all-time high set at the beginning of the year to the low set in June. Not really anything has been decided right now. We've been able to retrace down below the different fib levels currently. This goes back even a little longer to a low that was set in 2021 to the all-time high. We're kind of in no man's land right now as far as this is concerned. So we're looking more at short term right now. This is just showing, going back to the COVID low to the all-time high, we're not quite back up to what could be acting as resistance, but we did break down through some support. So again, I'm focusing more on the short-term Fibonacci retracements right now, and then see how they play out in the intermediate and longer-term charts. Sectors on Friday, since we had a down day, we had the usual suspects. Communication, that was down the most. Real estate, which has been having some trouble. Healthcare, which has been doing okay, but it still got hit pretty hard. There was one sector that was up, and that was energy. Because of the freak out in Europe, that's pushing prices back up, and the energy sector as a whole was pretty much the only sector that advanced. Here's the scooter technical analysis ratings showing that energy and utilities, they're looking the best from a technical analysis standpoint. Staples are into the 80s, and then you have communication, which is down below 10 at 9.8. Then looking at all the sectors, where energy is still performing the best and has since the all-time high, followed by utilities, with all of the other sectors being negative since the all-time high. Here, this goes back to the all-time high set in the S&P in January, and it just shows how the Dow has held up the best, followed by the NYSE. You have the NASDAQ and the NASDAQ 100, which have performed the worst. Technical alerts, few positive, few negative. First, the S&P got above 4,000, and that was pretty much the good thing that happened for the S&P, where the NASDAQ was bouncing around, going above and below different levels. And the Dow, at one point, was able to get back above 32,000. Then our technical scores showing that the Dow is now back in first place. And now this sucks as an overall score. We want this in the high 80s and into the 90s for this to be really positive. It's at 65.7. So just because it's in first place doesn't necessarily mean things are positive for the Dow. Followed by the mid caps at 62.6, and then the S&P 500 and 52.3, and then small caps. See how they've been really trailing off here. They're at 36.4, and the Qs at 25.5. They're continuing to look a lot weaker. The Qs and the growth stocks, they're the ones that really scream to the upside when we're going higher, but they also scream faster to the downside when we're going down. Let's look at the intraday chart. We gapped higher right at the open, and we went up to R1, kind of fell back a little bit, and then shot up to R2. We hit a lot of resistance. We spent a long time at this level right here. And when nothing was really happening, and then some news broke out of Europe, and they said, well, okay, nothing's really going to happen here to take us higher. Let's start selling. And that's what happened. We fell below R1. We came down to the dashed line here. This is the unchanged level. Didn't really pause there for very long. Then shot down below the daily pivot. We actually went all the way down to S1, tried to bounce a little bit off of that, broke through S1, and then saw a little bit of buying coming into the close, and we closed right at about S1. So not a positive day, to say the least. With our trend, we're starting to see this roll over. The dark line, that's the ADX, and it's starting to turn up. The red line is on top, even though it decreased slightly, and the green line increased slightly, but this is starting to show that the trend is negative and it's starting to get stronger. The Arun, it finally shot up here and took us down negative as far as our oscillator. When the red line's pegged near the top, that means sellers are in control. And we're seeing the green line coming down, which means buyers are taking a vacation. When you compare the two, that's the result of the oscillator down below. And we are negative. Looking at breadth, another down day. We saw a decline based on price and volume. The advanced decline ratio is also declining and not necessarily extreme negative. The new highs, new lows are trending lower on a 5-day basis and on a 10-day basis. Accumulation distribution, we're below the moving average, and the moving average is starting to go down. Short term, we're coming out of a slight extreme negative reading. So I just wanted to show this chart. We could easily drop back down into that, but over the last 5 days, it shows that we're not necessarily extreme right now after we had been so. Looking back 10 days, we're getting to pretty much extreme negative territory. Moving averages, where we were starting to break above the moving averages, now we're breaking below them. And notice how we came right up to the 50-period moving average. That was another level of resistance, which also lined up with a pivot level. That's as high as we ended up going, and then the S&P shot down after that. You can also see how volume dropped off in Friday's session. Our short-term indicators are still giving us oversold indications, like the Stochk RSI, the Williams percent R, the Force Index. It's not quite as oversold as it was, but it's still pretty extreme. Swinland Trading Oscillator, starting to get extreme based on price, still falling based on volume. McClellan Oscillator, extreme negative. In our 20-period moving average study, it's extreme. The 50 and the 200 continue to decline. At least the 200 is turning down a little bit there. Stoke, looking at stochastics, we're extreme negative with the short and intermediate term. We're still declining with the longer terms. Looking at some intermediate term charts. This is the 50-period moving average, where we came right up to that simple moving average. That is a major moving average that millions of investors use. If we had broken above that, things would have been more positive, but we went right up to that level and then came down. The Sean trend meter is pretty much flat right now. The PMO, another oscillator that we use, is declining based on price and volume. The PMO study, we're getting extreme negative with the PMOs that are rising, as well as the number of buy signals, and we're declining with those PMOs that are above zero. Chaikin Oscillator also declining, and the Chaikin money flow is also declining. Volume, it picked up a little bit, but we're still below average. This is picking up the big days that we saw the last day of the month and the first day of the new month. But now we're rolling over a bit because we went back to being below average. The vortex, the red line is on top, even though it decreased, with the green line on the bottom. So this is negative. And our summation index based on price and volume is negative, and volume has actually dropped below zero. All of our oscillators are going down currently. The BPI is starting to decline, and once it drops below 50, that will generate a technical alert, and that will make things more negative. The ease of movement is also showing a decline going back 14 periods, where it actually went up a little bit on the 1 period. Ultimate oscillator declining. Money flow index declining. The CCI 14 periods is extreme negative, and it's also extreme negative with the 20 period. This I wanted to show the RSI 14, which that's usually the default setting that most folks use. It hasn't gone extreme negative yet, but when you look at a 9 period RSI, we are going extreme negative, and that's shorter term. Looking at the 19-day exponential moving average of the advanced decline ratio, we're starting to get down pretty far based on price and volume. Sometimes when this gets extreme, that may provide some support for the market. The TTM squeeze, it is with the lighter shade of red and continuing to fall, and that is negative. And we've dropped below the anchored moving average here that goes all the way back to the COVID low. Balance of power is below the dashed line and declining. That is negative. Here's one that I don't show very often, but this is also giving us an oversold indication. This is the CMB composite index. And the reason I looked at this is see how extreme we are with the black line. Well, we gave an extreme reading back in June and then had a nice little run up. We gave an extreme reading, where was this? Well, not really extreme back in March, and then it really started to run up. But this is getting a little extreme. We usually don't go down this far. Back in February, earlier in the year, we gave an extreme negative reading and then saw a bit of a recovery in the market. So just something to be aware of. Different charts. Our Heiken Ashi is negative. Kegi is negative because they're red. The Renko chart have 3 red boxes. That is negative. 3-line break is also with fully black candles right now. That is negative. With our point and figure chart, we added some new zeros this past week, so that is turning more negative as well. In our trading systems, the Elder Impulse in the S&P 500, it is switched to negative. When it turns red, that's negative, as it is for the SPY. The SAR system, this is stop and reverse. When the dots are on top, that's negative, and they've been negative for quite a while now. The go, no go system has flashed a signal. We've gone back to deep purple, some smoke on the water here, folks. This is a mechanically driven system, and when it goes to the deep purple and it flashes the no-go, that means don't go long at this point. So that's quite negative. Long-term charts. After coming all the way up to the 200-day moving average, we're now dropping down out of the moving average rainbow tree. We're declining with the 50, 150, and 200 simple moving average studies. Special K is really rolling over as well. That's a long-term oscillator. Looking at the broad market, the Dow has now switched back to negative. Here's the Dow. Not a lot of additional damage was done. We did set a new low in Friday's session with the Dow, based when compared to Thursday. The Qs, they're also, after being neutral, well, they switched back to negative on Friday. And here's the NASDAQ 100. It did not hit a new low from Thursday to Friday, but still saw some pretty negative action. The Vixen, it's pretty much going sideways on a closing basis and not really going up as you would expect as prices fall. Here's the NASDAQ itself, not a lot of additional technical damage. Breaking through this 50-period moving average, that was giving us some hope. Well, we now have that in the rearview mirror. The mid caps also were giving us some hope for a while, came up to the moving average. That's where they opened, but then dropped down below that. The Wilshire, it used its 50-period moving average as resistance, and then we fell down after that. Looking at the dollar, it continues to hold up well, even though it was down slightly in Friday's session. It's in an overall pretty strong uptrend. My goodness. And because the dollar was down slightly and the S&P was down, that's why this has turned back up. And so they're not having as strong of an inverse correlation as they have been having. Gold, it actually bounced up a little bit. It was up 0.88% after just being in a really solid down, real gravity driven price action there. Same thing with silver. It really gapped lower, but saw some recovery in Friday's session. Oil, it actually was up slightly to 86.87 when everything closed. Kind of the big deal now is they're trying to keep, from an economic standpoint, can they keep oil under 90? That's still very high, but when it breaks above 90 and gets into the 100s, that's when it really does a lot of damage to folks. And then the correlation between the S&P and oil, well, they both have been going down now. So they had a pretty strong inverse correlation. Now they're starting to go in the same direction. Looking at bonds, we're just not seeing a lot of good things here. Even though we were up 0.25%, it looked like we were forming a base. We were coming up out of that, but now we're coming back down. And this chart is even more negative. This is the World Bond Index. And see, we're going back and testing the lows of the lows at the COVID lows. And if we break below that, that could really not be good for bonds. The correlation between stocks and bonds, they've both been going down, so they have a pretty strong relationship that means they're going in the same direction. Currently, our yield curves, not a real big change here. The 10 to the 5 remains inverted. The 10 to the 2 is still inverted. We're still watching the 10 to the 3 month, and it has not gone inverted, but we're watching this every day to see if that happens. The tech sector to the 10-year yield, they're still tending to go in the opposite direction. Tech has been going down as interest rates have been going up. Yields, they came down quite a bit in the longer maturities, but we're still seeing some overlapping here, and this is what's causing our inverted yield curves. Okay, our scenarios, again, we're not really taking these serious right now. We're just using them to see any updates that we can get. But this is what I'm starting to notice, where we saw a trigger down here, and then we started to go back up. Well, look at how it's starting to fall now. Is it going to come down and possibly generate another signal? These are the percent of stocks above their 200-day simple moving average. This is the S&P 500 with those stocks above their 50-period moving average. That shot all the way up, but has really been coming back down. The mid caps have also been showing some weakness, as have the small caps. We're also looking at the 10-day average of the S&P 500 highs and lows. After giving an extreme negative reading, we shot up and actually went extreme positive, but now we're starting to fall back down again. Will it generate another signal? Looking at the Amex, NASDAQ, and NYSE, using a 5-period moving average of the highs and lows, we are below zero and declining. So that's just adding more to this negative backdrop. We had seen an extreme negative reading and we're getting some support out of that, but that seems to be breaking down currently. This is the chart that I talked about at the beginning. This is the 5-day equity put call ratio. And I just show a short-term version of the chart. This is a longer-term version. This is the spike that we were working off and we were coming down. Well, now this is starting to go back up. Are we going to go above this level and possibly generate a new signal? Small cap index, really having some trouble as well, broke below the 50-period moving average. Didn't really set a new low in Friday's session, but still not looking all that healthy. But on a comparative basis, the small caps are really underperforming the rest of the S&P, so we're not getting any help here. The red line, we want to see this going up because often that will give some support to the S&P. We're seeing the opposite of that right now. Here's the S&P to the 10-year yield. They're still having a tendency to go in opposite directions from each other. So if interest rates are going up, especially the 10-year, that might mean the S&P is going down and vice versa. Here's our positive rotation that we've been using. It is really showing some weakness when looking at the Qs to the S&P 500. That's declining now, where the discretionary, this is holding up. a little bit better, but the large cap growth to large cap value, that is showing some weakness. And here's the pretty much the same chart, large, mid, and small caps. They are showing some weakness. So discretionary is hanging in there, but we want to see all of these things hanging in there and get above that moving average. And that's just not happening as prices continue to fall. Here is the correlation between the S&P 500 and the 2-year yield. They still have a pretty strong inverse correlation with each other. And we're starting to take out this spike. This is what I was kind of concerned about. And it looks like we're going above that now. The staples also showing some weakness, even though they're getting really near a golden cross. It's kind of amazing. We get down below this and we have a death cross, and then we go above it and we're getting back to a golden cross. So we drop below it. I think the market's a little uncertain right now. This is still hanging in there as far as the signal. We're still working off the most recent spike, even though we're seeing the ratio continuing to advance. All right, so what's our outlook for Tuesday? I've already said this, the markets will be closed on Monday for Labor Day. The technicals, they're negative, but they're short-term oversold. We even have a few intermediate term indicators that are oversold. We have the IHS Market Services PMI coming out. That's not a big one, but we do have the ISM non-manufacturing index. Now, this past week, we had the manufacturing index. On Tuesday, we're going to get the non-manufacturing index, and this is a big deal. All the different geopolitical events, and I'm highlighting the ones that the markets are kind of fixated on right now. Then our scenarios, we still have to go with the down scenario because of all of the different headwinds that the market's having to deal with. The technicals are negative, but the trend line is holding, and it's short-term oversold. We might get some kind of a bounce from that, but we're still negative. We're going to need a lot more than just a little bounce up to turn this market back more positive. So we can't really go with that scenario. And will we find some support at that trend line? Our scenarios, our setups, our rotation, those are all on hold right now and might even be getting ready to generate some new signals. The technicals are negative. We're losing the moving averages. We're dropping through pivot levels and retracement levels. Some are holding up, some are not, but this is looking negative overall. So we can't really go with a positive scenario. And we're not really sideways because the ADX is starting to turn back up and it's above 20. And with the red line on top, it is negative. So our conclusion, the S&P is negative, short-term negative and oversold, intermediate term negative and becoming oversold if we see some more weakness. Long-term, we're below the 200-day simple moving average, so we are negative. So thank you. This is the full-blown video. I will prepare the daily brief video for Tuesday's session. Have a wonderful weekend. I will prepare the weekly video and the intermarket analysis video. I might be a little bit later with those because of the 3-day weekend, but look for those to be posted sometime over the weekend.